Hey everyone, I am on the road again this week, right now in Orlando, Florida. I know you can't see much but the hotel room here, but there's a beautiful view uh, just looking out here to the right. I wanted to talk about the potential bull case. And what's important, I think one of the easiest ways to get into an argument or some sort of a discussion where you don't see eye to eye with other investors is when you don't have the same time frames. Um, I've got CNBC on right now, right here in the room, and I can tell you a lot of the discussions that I see, and this is always the case, where there's disagreement between panelists, is just basically one of time frames. So. Which brings me to the point of the video today. We're going to get right to the point here. I think immediate term, and I think we've made this very clear over the past couple of weeks, probably in the past couple of months, depending on which stock we looked at, things are very, very frothy. Stocks like Apple, stocks like Tesla, dare take that word into my mouth, NASDAQ 100, Microsoft, Google, extraordinarily overbought. List goes on and on. Large cap tech stocks. By the way, I just read a statistic just this morning in the Wall Street Journal that tech stocks actually tend to underperform in years of election years, U.S. election years. Of course, this year 2020 being one. So just kind of take that into account, or at least with a grain of salt. So that's immediate term. That does not mean. I just want to clarify, just because I think things are severely overdone in the immediate term, particularly in the large cap tech space, it doesn't mean we can't ultimately see an up year in the broader equity market, right? But I do think we could see, and I know UBS was out with a note, or UBS, or I forgot which one of the large banks was out with a note on this about 2 weeks ago, that they think we could see very much a V type of year where we do have a sharp drop off at some point this year, which I think is very likely, and then an equally sharp recovery through the election kind of thing. I think that's actually a very plausible analysis. Now, it's usually not as simple as this and like this. So you got to take the data into account every day. But I wanted to show you guys the potential bull case. I tend to look at the New York Stock Exchange Composite. Some of you guys that are regular viewers of this video, you guys know this. And I was actually, quite frankly, some of you guys might know this, I was quite surprised that we saw a breakout in the New York Stock Exchange Composite a few weeks ago. Again, this is largely due to the Fed's liquidity dump into the markets. Certainly, fundamental data, economic data hasn't gotten much better, although in Asia we're starting to see better data, and we have the trade deals and all those things which kind of leads to algorithms chasing things and things like that. But nonetheless, I think the bull case, if you want to have one, is that the New York Stock Exchange Composite, which is much less heavily weighted, the Apples of the world, so it's more sort of a broader swath of equities, looks like it has upside. So this is a multi-year weekly chart. Let me kind of pull back the chart, and you can see this is the long-term chart, basically for the past decade. So if we want to get back to the upper end of this range at some point, this is not an immediate term call. Again, to be very clear, this is not. I'm not calling for this right away, but it is not unfeasible that the New York Stock Exchange Composite, ticker symbol NYA on a lot of platforms, does ultimately reach the upper end of this channel right now. And this upper end of the channel, of course, moves as time progresses. Right now, the upper end of this channel, just to give you an idea, is about around 15,000. Maybe it could be as high as 16,000 ultimately if and when we get there. But that's right now where it is. So that is roughly another 5 to 6, maybe 7% of upside on the New York Stock Exchange Composite. So if you want to have a bull case from a purely charting perspective, we're in a broad swath of equities, which I think this is a much better chart than looking at the S&P. And just for shits and giggles, I'll have a look at the S&P, which has gone vertical. I think the risk is much larger in the S&P or the NASDAQ 100, particularly NASDAQ 100, to be honest with you. And by the way, I'm going off the script here, but just so you guys can see, we are at the upper end of trend here once again. We're way at the upper end of trend, actually. So I think the risk is much larger there. And again, it's largely concentrated in stocks like Apple's and those kind of things. Not because they're bad companies. I like most of those companies. Probably like all those companies, those big, huge ones, Microsoft, because of the stock price, because of algorithms, because of high beta chasing, indexing, which is, I think, is a big bubble. All those kind of things is accelerating those stocks at an increasing rate. And I think that's getting dangerous. So that's the near term. But ultimately, if you look at a broader sample of stocks, again, New York Stock Exchange Composite, I think has about 2,000 stocks and things in it. So it's a much wider array of stocks, there is upside there. So I just want to make sure I'm clear on that. Again, this is not an immediate term call. This is a call through the lens of maybe this year, maybe in the next year. So again, anyway, I hope this is helpful, folks. If you guys have any questions, comments, or concerns, leave them down below. Help us spread the word. Give us a thumbs up, like, and we'll talk to you soon.